Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about the Fed meeting and what to expect next on mortgage rates. Before we dive in, I want to thank our sponsor, Trust and Will, for making this episode possible. Logan, welcome back to the podcast.
Happy Fed Day, and just like what we talked about in the article, Jerome Powell was going to be hawkish, and that is in line with how he has acted before when the 10-year yield is down here and inflation is above target. He tried his best to really get people off of the December rate cut being 100%. The markets didn't 100% fully buy into it, but the last time I checked, the 10-year yield was at 407. Much different story now than in 2023, but definitely he very, very hawkish in the sense that he really wanted to get people off of 100% rate cut happening in December.
What did he use to justify that when we don't have jobs reports? We don't have what is he using to say hey, you should be cautious about the December rate cut?
So what we've always talked about with the Fed is they need the labor market to break. And breaking means jobless claims data going vertical. We do have state jobless claims data. And when we look at it in the aggregate, jobless claims right now, if it was out, it would be 235,000, 240,000. So it's elevated from the lows, but not breaking yet. He talked about the job openings data a lot. So when we do the NER tour, everywhere we go, we always bring the job openings chart and the jobless claims chart. So these two are the Fed's favorite. I think he said it 6 times today, right? If you were doing a drinking game, you're already lit up for the rest of the day. So in that context, he stayed very true to himself. And even with job growth being very slow, he said there's no layoffs. So the job market has to get, I don't see it getting significantly worse. They can't get any worse because some of the reports are already negative. So I think he really stayed true to himself in terms of trying to push back on the rate cut in December. And, it's not a foregone conclusion. He even said, hey, listen, if the labor market starts to pick up, hey, we might not cut rates. So traditional Powell, the labor market needs to break, right? You could soften up, but, he talked about the labor supply 3 times that, it's really the labor supply. And on Twitter, I kept on showing manufacturing jobs being lost since 2022, labor supply. Yeah, right. Construction workers being jobs lost, permits are at recession levels, labor supply, no. So there's sectors of the economy that the AI CapEx boom, which was a lot of the discussion in the Fed presser as well, that doesn't really impact the manufacturing data that's been losing jobs since late 2020, or construction workers losing their jobs because housing permits are at recession. With all that said, the bond market has done so much for them already. This is why when we're down here, I always say, boy, you really need something worse to push it any lower. And bond yields ticked up, stocks sold off just a little bit. That's pretty normal with how Powell operates and how the Fed acts usually when we're down here with the 10-year yield and mortgage rates. Okay,
so that was my next question. So yesterday, we are recording this on Wednesday, right after the presser. Yesterday on Tuesday, we got down to the 2025 low in mortgage rates again, which was 6.13%. And you wrote an article, will the Fed ruin the lowest mortgage rates of 2025? Which I have
and
to
he
say.
did. And he did. And just on cue for how he has acted before when we're here, he likes to push back. See, if you took the layup would be, by the way, it's job growth is slowing down because deterioration is happening in certain sectors and rates are too elevated. He could have said that. He doesn't want to. He does not want to because he needs to see the labor market break to get to that next level. He did talk about, well, there looks like to be spending from the upper income class and they're doing well, but spending on the lower end is getting hurt. And what we've said before, they don't care because he needs pawns, right? They need to have pawns. They need to see weakness, credit deterioration on subprime autos. Yeah, whatever. He's like, well, we don't think it's a big deal. So it's funny. A lot of things, Sarah, you and I have talked about the last 2 weeks. He went over all of them in this report. So it was a really good one in terms of a lot of our talking points. So Powell basically stand right on cue. And this is why I always say, when we're down here, with mortgage rates and the 10-year yield. So much is priced in already that you really need something big to change that to get it to go lower. And I don't know how bad the pricing is going to be after the Fed meeting, but it's definitely going to be negative. So Powell, right on cue. I did a AI picture of him stuck in one of those, grocery bags with his face covered and him screaming. And I said, it's Halloween week and it's Fed week, so expect Powell to do something. So I would say he just stayed true to his nature. But again, the 10-year yield is at 407. I don't know. By the time this podcast comes out, who knows where it'll be. But just as the initial market reaction, bond yields go up. Some of the rate cut pricing in December goes down a little bit. The market wasn't 100% all in on the let's this really take the December rate cut off. But vintage Powell, when we are here down at these levels with the 10-year yield.
So I feel like everybody still has, PTSD from this time last year. Of course, it was the September rate cut by Powell that afterwards mortgage rates went higher. Everybody's worried about that happening. Didn't happen in September. What do you think about now? What are the chances that mortgage rates actually go up in any meaningful way?
Not in any meaningful way like we did last year. Because last year at this time, we were already at 7%. Like we are already now. There's certain variables that are factual that are apparent now in this year that weren't the case last year. Now, last year, bond yields, there's a lot of, I would say, incorrect takes on what happened last year. The 10-year yield was at 362. It broke the Hodor line, right? You don't break the Hodor line unless you think you're going into recession. So the bond market overreacted to the weakness in the data, and the Fed just cut. So Fed policies up here, 10-year yield is down here. They've got to converge, right? Because they're pricing in way too much weakness. 10-year yield went up as it should have. Mortgage rates went up as it should have because the Fed, which they've repeatedly said today, modestly restrictive policy. So that made sense last year. This year, the 10-year yield today with a hawkish Powell is 4.07%. It's not the same thing. And also spreads are much better this year. Hug a mortgage spreads, take a selfie. When you see it, come for candy. Sarah Wheeler, when you're in your Little Red Riding Hood, purple Barney outfit you're wearing, you see a mortgage spread, you get it. I'm going to try to find a mortgage
extra
spread
candy
costume. I'm going to be a mortgage spread for Halloween. That's what I'm going to be. And I'm going to get like a big, Wonder Bread and get a big knife and some jelly and spread a little love everywhere. In any case, much different marketplace, much different 10-year yield, much different mortgage market. We're close to the year-to-date lows. It's almost Halloween. Last year we're over 7% already. So much different backdrop on the economic side. And again, the only reason we're here is because the labor data got softer. If it wasn't for that, mortgage rates would be higher, because the Fed will say we're modestly restrictive. So hug a mortgage spread and thank bond traders for getting ahead of the Fed. They do a lot of what we've always said, heavy lifting for the Federal Reserve early on. And it makes sense out there because we're not at neutral policy. If we're at neutral policy, it's much different because, if things get worse, they're at a better spot to handle it. But they've kept on saying the labor market isn't breaking. And we do have jobs data on the private sector sides that show that the labor market isn't breaking. It's getting very, very soft. We have some negative reports, all these, they don't care until it breaks, right? If today was a great day for those who said the labor market needs to break, they said like 6 times, job openings, jobless claims, job openings, jobless claims. Why those two? Because they have discharges and layoffs and fires in them. And they're still very low on a historical basis. So here we are. Vintage Powell on Halloween week. That's why we kind of did that article yesterday about, is he going to ruin it? Most likely, yes, because this is kind of how he acts. But in context, much different this year than last year.
Much different. Okay, we had Treasury Secretary Bessent gave 5 potential. They've narrowed it down to 5 people who could take Powell's place, be the next Fed chair. Do you feel like, because you've talked about the shadow Fed president now for, 6 months, now that they've finally done it, they haven't narrowed it down to 1, but what do you think that does to Powell's influence or his power?
I, I was always thinking October and November would be it, but obviously we're almost in November. Um, the December meeting is December 9th and 10th. If you still, I mean, they could have done a shadow Fed. I just think he likes having Powell there just to punch, right?
Yeah.
So that's a good punching bag for him. But I don't know if you wanted to throw a theory out there, maybe 1 or 2 weeks before the December meeting, since Powell is trying to push back on the December rate cut. Um, you know, it's coming. We all know Jerome Powell's toward the end, so it doesn't matter. Whoever he nominates is going to be more dovish than him. So the closer you get toward that end, but in this case, I think the bond market is properly pricing everything. I think there's more discipline in bond traders this year than they were last year. Last year, they totally freaked out. We call it fragile Fraggle Rock crew. Usually that's stock traders, but here I think the bond market's done a really good job with the 10-year yield priced based on a Federal Reserve that's modestly restricted. So whenever they announce the next Fed chairman, that person's going to be obviously more dovish than what Powell is.
Okay, so mortgage rates for the next little bit looks like we're going to be in the same tight range, not your whole forecast range, but in the same tight range we've had for the last, say, 2 months.
Yeah, it's really, really hard to go much lower from these levels because so much is already priced in based on a Fed that is telling you they are modestly restrictive. And now they're trying to tell you don't put all your eggs in the December rate cut. They are literally telling you this all the time. So this is why I always try to defend the low end of the forecast. I don't want to tell people something that they want to hear because that's just not how the model works. You got to go back in history and model out Fed funds rate, growth rate, everything. That's why we create these ranges and what the data works off of. This is why we get very protective on the high end. As we did around 470 when the 10-year yield was slightly above there. We said, hey, listen, the economy better be booming because we don't belong here if that's the case. We're all the way down here, and that's why we do channels. We do channels and waves and models and forecasts. We don't target mortgage rates. We target the slow dance, right? The slow dance between the 10-year yield and 30-year mortgage rate and the mortgage spreads and all that stuff. Again, much better spot this year than last year. And of course, purchase application data came out today. Pending home sales came out. Those are, again, two interesting housing data points as well.
Okay, so pending home sales was the first thing I was going to ask about because obviously in the tracker data, it looked really good. And you were like, hang on a second, we have to put this in context. So tell us what the pending home sales showed for last week and why you think there's sort of an asterisk there.
So our weekly tracker was a little bit too strong because I think they caught an extra day into the data pool. But there's a lot of people that are saying that
because of the AWS outage,
yeah,
right?
AWS outage. But we did see a rebound out there, and again, our pending home sales have been positive year over year for majority of the time past May. So and that's been the case. Existing home sales have been flat in year over year growth for the last few months. Probably have one more print where we get that. The pending home sales data, like there's this discussion. What is the shutdown doing for the housing data? Every day people I get all this stuff sent to me. 1,100 transactions aren't happening because of the shutdown. 1,400 transactions a day aren't happening. If we were going to see something, we see it in the pending first, but it really comes into the existing home sales report because that's closings. I don't see anything in the data that's very big due to the government shutdowns, but I do see closings, things being delayed a little bit. Like, do you want to start on a house? If you need flood insurance, you don't know. Those kind of things make sense to me. And that's kind of what I saw in the pending home sales data. So the next existing home sales report could get hit just a little bit on that. And then on the back end, whenever the government shutdown ends, and Jerome Powell even said this, the government shutdown eventually will end and then things will revert back. So whatever slowdown you see in the economy, you get the upkick. So that's how people should look at the housing data with the government shutdown. A lot of people have different takes, but if people are telling me that nobody's applying for a mortgage because of the government shutdown, go positive 5% week to week, 20% year over year growth. We've had the best 13-week period the last 13 weeks, and that's when mortgage rates got below 6.64. So you can make a case maybe the week-to-week data was a little bit softer because of the government shutdown, but I just don't see any big major implications yet. And if you get a little bit of hit on the next existing home sales report, if the government comes back on, we'll just move it forward. Hopefully we get so sick and tired of these government shutdowns. They're so stupid. They're so inefficient, and they're just like whatever, right? It's just like we have way too many old people in Congress. Way too many old people. And the old linger way too long anyway. And you know what? We have a whole opinion on baby boomers anyway. But y'all got to like act like adults.
I actually think what you just said is probably the most bipartisan sentiment that you could ever say, which is like there are maybe just too many old people in DC at this point. I think no matter where you are on the political spectrum, you can look at that and go, I think we can do better.
See, I was going to end my all housing economics writing at 2024 and say like, someone else should take my spot. You know, I've done my duty for whatever, 13, 14 years. Now somebody else is going to do it. So it's obviously didn't end, but I'm going to be glad to let the next generation, next young people come in, because you need young people to get in there and get experience and then ride it out for 15, 20 years. The old lingering, it's toxic, it's poisonous, right? It's just not, it's just, you need fresh new blood and you need younger talent to come in there and things change. But if you do things the old way, they hold themselves into power, like in every bad movie you've ever seen. The old never like to give up power, right? You know, so again, there's way too many baby boomers in Congress and out there. So hopefully eventually things change and get younger people and, you know, get these people out.
Okay, so we've talked about the Fed meeting, we've talked about mortgage rates, 10-year yield, purchase apps a little bit, and pending home sales. What else are you looking at?
Well, to me, it's with the housing data, purchase application data has now 8 positive weeks out of the 13. What I've always tried to stress over the years is that you really need 12 to 14 weeks of positive week-to-week data. And we showcased this today when the pending home sales data was basically flat month to month. It was down a little bit year over year. The reason I like to say 12 to 14 weeks is that the weekly data, it takes 30 to 90 days to hit. And the reason we say this shift is the Case-Shiller Index, Home Price Index, and the FHFA Home Price Index came out this week. FHFA said, oh my God, surprisingly, home prices picked up. Case-Shiller, by the way, I know it's bad for the doomers when nobody talks about the Case-Shiller report, because these people were running on the month. This is how inexperienced some of these people are. The month-to-month data was being negative, even though starting from April, the negative data started to get less and less. And they said, well, because Case-Shiller is showing negative month-to-month data, home prices are really crashing, because we only saw this in 2022 and we only saw this in during 2007-8. So everyone ran with this. All of a sudden, even the Case-Shiller Index month-to-month prices surprisingly increased. Sarah, are you surprised?
We are not surprised. You saw things change starting in mid-June.
Yeah, and I'm telling people, if you are still listening to somebody who's still saying the housing market's the same today, they're playing you. They're like, oh my God, I hope they don't listen to Logan, because Logan's making fun of us because we didn't pick up on this and we're still saying the same things. The supply and demand equilibrium changed mid, so it shouldn't have surprised anybody that both the Case-Shiller and the FHFA home price, because it's a lagging data line. It's a 3-month average. It lags us. So the curve just picked up a little bit. And again, for myself, I had a much lower price forecast than anyone else, because our slope of the curve just basically, to me, was pricing in back-to-back years of negative real home price growth. So it looks about right to me, but I think a lot of people just jump the gun. Everybody wants to be this somehow a hero and say, home prices are crashing, home prices are falling. And then all of a sudden, nobody talked about the Case-Shiller today. I sat there on social media like, anyone, Bueller, anyone. And I was like, oh my God, it must be that bad of a day. Because I do not remember a day that literally no one talked about Case-Shiller. And I didn't say, I said, guys, it shifted mid-June. Y'all want to come on the real train, come on to the Logan, choo. Let's get that going, right? Live, fresh weekly data, because you don't want to be 3 to 6 months behind. And it's November. And that's a lagging data line too. So that was good. But again, purchase application data, you get 4 to 6 more weeks of positive. You get that 12 to 14 weeks. And you got something material, and it goes with the last few years where we get a couple 100,000 more home sales. We're just quite not there yet. But again, that's why we have the tracker. That's why we work off data. It's a little bit tricky when you have government shutdowns or something like TRID. Like TRID really crashed sales 1 month, man. It just let a waterfall dive, but then it shot right back up. This will be a very mild version of that. But again, a fine week, 5% growth week to week, 20% year over year. The comps are really low because last year at this time, mortgage rates got up to 7% again. So it hit the weekly purchase application and just a little bit of growth. That's all it is. That's all our tracker was talking about. That's all I talked about 5 months ago when I said months of June till October, reports July to November should be positive year over year just because of the low bar comp. So not bad considering what we needed. Price growth cooling down, inventory up, very healthy year at housing. We've got 2 more months left. We got 1 more Fed meeting. Hopefully we get all the job reports out and then we just take it from there. We get ready for 2026. So we could end this whole, the greatest inventory and buyer gap in history, the highest percentage of cancellation rates. And oh my God, prices are, what? Homie said, what? Y'all should just leave, go to cars or something, collect garbage pail kids, do something else. Housing isn't your thing. Housing is not your thing.
Another 90s reference, garbage pail kids.
Yeah.
Who ever thought of that?
Garbage pail, strawberry shortcake, Care Bears, whatever it is. Housing just isn't your thing. And some of the stock traders out there still like, there's a lot of conservative stock traders who want rates lower because they're pro-Trump, but you have to be realistic. And they kind of somewhat embellish the housing weakness by saying, oh my God, the Fed needs to cut rates a lot more because historically speaking, prices never fall without a recession. Well, Austin's price has fallen. They're not in a recession in the city. It's a little bit different out there. So that's why we created the Down in Fraggle Rock, boom, boom, the Fragile Fraggle Rock Twitter people out there, which like now that the pricing's firmed up month to month, that was the data line they were using. Zip, silence. The builder's confidence index picked up a little bit. It's just a little bit pickup growth. They were using that as well. Silence. Actually, one of them didn't, but still, it's okay. It's an okay housing market considering all the factors. So you don't have to go out there and scream the Fed needs to cut rates, do QE or anything like that. They're basically stuck in this, the growth rate of inflation is at 3%. Their target's at 2%. Wage growth is still too strong for them. We're dealing with this on a daily basis, but try not to panic so much all the time. We're going to make it. How many surviving of the 4% 10-year that I do in the last 10, 11 days? We're okay. And if it comes down a little bit lower, we're going to survive it again.
Logan, thank you so much for talking to us on Fed Day, and we will talk to you again soon. Appreciate it.
Down a Fraggle Rock.